No.
He's playing with the damn. He's playing with the Vision Pro. Man.
Carlos is not joining us, folks, because he's stuck in his Vision Pro. He's last night.
VR porn is strong. It pulls you in.
Yeah.
It does pull you in. How was your guys' day in the market? How'd you guys? What happened today? What'd you guys do?
Nothing. Today was a good day in the market. You know, everything's been on a tear, man. It is worrying a little bit, to be fair, but I mean, this is where just set up some stop losses and call it a day. You know, we'll see where things go. There was an interesting little back and forth I had in the chat to explain a couple of things. So maybe we can do that today.
Okay.
So it's around short selling. Amit, do you know how short selling works?
I understand it at a conceptual level that you are borrowing shares from the market that are not yours, and that the delta between where you borrow them at and where the stock price goes, hopefully down, that's the money you get when you buy them back to the market or you sell them back to the market. But that's the gist of what I know. Yeah,
and that's 100% right. So someone in the comment section was asking, what does borrowing shares mean, or stock lending? I got an alert on my Fidelity account saying, hey, do you want to lend stock? Do you want to do stock lending? Now, the thing is, in terms of risk, there is no risk to you because your broker is going to be guaranteeing that your shares will come back to you. And also there is an upside.
I'm doing the lending, by the way. I read through that. So there is a chance that you don't get the shares, but they're keeping money in an account that is equivalent, and then it gets reevaluated every so often. But you could possibly lose the shares. That is possible.
You wouldn't lose the value of the shares, though, right? Because essentially that's what the broker guarantees. So essentially, let's say I have 1,000 shares of Meta, right? And someone says, you know what, I want to short Meta. What they would do is they would go to the broker and say, I want to short this company. So what the broker does is say, okay, sure, here's 1,000 shares that belong to VITALY. They belong to you now, but now there's a credit that's associated with it. So you owe us 1,000 shares. What that person does is goes and sells it into the open market. So they would collect all that credit. Now, if the stock price of Meta goes down to, let's say, half the value what it was, remember, what you owe isn't the dollar amount, it's the number of shares. So they would go back into the open market and have to buy those shares, and then give them back to you. So they would give you back 1,000 shares. Now, you as the person who's lending those shares do get certain interest from that. So it's not like they're borrowing it from you for free. They're actually paying the broker, and the broker is giving you that money as well. So if you sign up for share lending, that's fine. Now, here's the thing that can really suck for short sellers. Sometimes they short a company and it just skyrockets. It goes to the fucking moon.
Right.
So imagine right now you shorted, you said, oh, SMCI, it's $500. It's too much. I'm going to short it. Right. So you go into the open market, you take $500,000 and you say, you know what, I'm going to take 1,000 shares of SMCI and I'm going to short it. And instead of it going down to 250, it goes to 1,000. So now you're responsible for $1 million worth of buys.
Explain how you got to $1 million. Explain that number. How did that happen?
Okay, so imagine right now you had like 500,000, right? And you took 1,000 shares at $500. You sold it short, right?
Okay. So you have to give 500,000 to the market to short.
No. So basically, what happens is you're going and saying, I'm shorting this company. Okay.
Right.
That means that now they're going to lend you those shares. So you're going to have in your portfolio balance negative 500,000. Now, usually that negative 500,000 has to be backed by collateral. So you need to have 500,000 already in there, right? Now, what happens is if the stock price of SMCI goes to 1,000, you owe 1,000 shares of SMCI at $1,000. So that ends up being $1 million. Right. So what happens now is that the $500,000 that you had in your account before gets completely wiped out. And now you're in margin status. So now you get margin called.
And if it goes to 1,500, you owe.
Well, if it goes beyond that 1,000, that means that your account is 0. So now you're in margin call status. Usually you get margin called before that because you need to have a certain portion. You can't have $0 in your account. So, just saying that when it comes to shorting, that's what happens. So if a stock goes parabolic, you get margin called because now the broker comes to you and says, no, you got to post more collateral. Otherwise, what we're going to do is we are going to basically buy the shares in the open market, right? And give it back to this guy, and we're going to take your $500,000. So now you'd be down to 0.
So I'm glad you brought this up because I signed up for this lending program maybe 6 months ago, and I was like, I don't see anybody lending shit for me. I don't know why. I thought Tesla would be more shorted, but they actually borrowed recently Bitfarms. So it wasn't a lot of shares. It was 1,000 shares, but they did borrow half of my position.
Borrowed? You mean they shorted your?
They shorted. Well, they're loaning out from me. It says it actually shows a big L, not for losing, but it shows a big L on. And this is the first time I've done this, so it was interesting to see. And I was like, oh, okay, how much money did I make? It's like 28 cents
per share.
No, I think it was like they shorted it for a day or two, so it was something. So the interest rate, whatever it was, I didn't take a good look, but it was interesting to see that process actually play out. Somebody mentioned doing covered calls instead of loaning out. Well, no, I have almost no risk loaning out these shares. That's the difference. I won't lose them technically in most cases. There is a small chance, Chris, if you look at the fine print I read over it, that it gets reevaluated. I don't know if it's daily or weekly. I forgot what it was on Fidelity, but the amount of your the shares there, it gets reevaluated every couple of days, every week, or whatever. So there is a period where you can possibly lose value, if that makes sense.
Yeah. So there are other ways to synthetically short a company also. One of them is you could just buy puts.
Real quick question. Yeah. Why do people say you can have an infinite loss when it comes to shorting? What does that mean?
It can keep going up. It can keep going up.
But if you don't have the money in your bank account, wouldn't the collateral go to 0 and then it's done? You're over.
You think they forget about you as soon as it goes to 0 for you? Your account is like, oh, it's at 0. Wow.
No, what I'm saying is like, so let's say in Chris's example, SMCI goes to 1,000. You're down 500 grand.
So before it gets that far, your buying power decreases, and they say, hey, put more money or we liquidate you. Put more money in or we liquidate you. Put more money in or we liquidate you.
So you have to cover in order to stop it.
Yeah, that's right.
Yeah, because your buying power is dropping.
Yeah, you will never be able to do 100% like that. I just kept it simple for the conceptual understanding for people. But most of the time, like someone said in the chat, at about 40%, dude, they're gonna start calling you saying, "Listen, when SMCI hits like let's say 750, you're already starting to get margin calls saying, listen, either you post collateral or we'll liquidate your position." So, yeah.
Okay, so then what are the other ways to short, Chris, that you were saying? Or other
methods? The other way, there's a couple of other ways that you can short. You could do something called, you could just buy puts. You could say, you know what, I think that this company is going to go down in value and I'm just going to buy puts. So you can go into the market and says, you know what, SMCI right now is trading at 1,000. I don't think it's worth 1,000. I'm going to pay to basically guarantee for me the option to sell at a fixed price to somebody else. Now, the premium that you end up paying is basically the risk that you're taking on. So the good thing is you're not unlimited risk. All you would lose is the premium that you're paying. That's the good thing about buying a put versus some of these other more creative things. The problem is with a put, it's usually time-based, right? So as the time goes, and if it stays above your strike price, that means that put is basically losing its value, right? So that's the problem that you have with puts. So if you go really far out, you might get, and it doesn't go down, it stays up there. You might end up, basically.
But there is a max loss. There's not like an infinite loss. That's the good thing.
Yeah. The max loss is what you bought. Yeah.
That's the better way to do it, to buy puts, because actually shorting, don't do that. Nobody do that, please.
Yeah. Another way that you can short, but this is more like synthetic, is that you can sell deep in the money calls, right? So essentially what you're doing is, let's do SMCI. Let's say it's worth $1,000 right now, right? If you go into your Robinhood, you can see that, let's say a $500 call right now for 2026 is selling for X, right? So
Right.
what happens now is that you end up selling that contract out to somebody, right? So instead of a covered call to the high end, you're selling a covered call at the bottom. So now what happens is, let's say SMCI retraces to 500, you get to keep all the premium. That person who bought that from you gets pretty much nothing. I mean, they get liquidated out. I mean, it just decays away. So that's another way that you could theoretically do it also. Now, the way that I typically will do that is, let's say for Palantir, like someone right now, Palantir's at 25 something. They said, man, I think it's overvalued, but I don't want to give up the shares. You know, how do I do this tax efficiently? Because it hasn't been a year since I bought it. Well, one of the ways that you could theoretically do it is go a year out and sell deep in the money calls on it. And so what happens now is that you're going to be collecting the premium. So, and basically that premium is going to guarantee you that what is that thing called? That downside protection, right? So let's say Palantir does go down by $5 because you sold a $20 call. What ends up happening is you get to keep the premium, right? And the call ends up going worthless.
Right.
You know?
Right. Very interesting stuff. Yeah, I think there's definitely ways to be bearish about a company without actually shorting it. Because that just leads to, potentially.
Well, here's a question. SMCI, let's say it goes down to 800. What is the leap on that? Can you look that up? I'm just curious.
Dude, I'm telling you, the premiums are just fucking monstrous. So
well, it's super volatile right now, so it makes sense.
Yeah. No, I'm thinking a lot of people are probably going to be loading up on this, believe it or not. So I don't think that we're going to get even a decent put value for these things, especially a leap. Like, look at this. Let's say you wanted to.
This is now in classic bubble territory, no matter what.
Yeah. Like, let's say
should we be buying puts, dude? Should we get some fucking puts on this thing?
No, look at the premium. Look at the premium that you're going to have to pay.
It depends what you're paying. And this goes back to our discussion on Enphase when he kept telling me to buy puts on it. They were super expensive. It was very expensive to buy those. So what is the premium on this?
Yeah, but it ended up working. Enphase went from 250 to 72, right? Maybe this thing does collapse and the puts actually print.
It's possible.
Yeah.
But you don't know that.
So
and maybe it collapses in 2 years and 1 day. You know what I'm saying?
The $800 put is trading for $233 right now.
So you would have to pay $233.
Wow. So you would be breaking even at about 577 roughly.
But you could sell the put back before it gets there, right?
You could, but you could definitely do that. But that's all dependent on the time too, because you have your intrinsic and then you have your time value. Like no one can tell you when this thing is going to crash.
That's crazy. So, yeah, that is expensive. Wow.
So someone made 30x in 10 days on SMCI. They took what is it, $500 turned into 15,000 because they bought one call within 10 days. SMCI is up 250%.
Wow.
It's on Wall Street Bets. I mean, dude, it's wild. I guess the question here is like every day we start off the show with SMCI, but it's at 1,000. It was up 2% after hours. Nvidia went down. SMCI took on a life of its own today. It said, screw you, step brother. I'm doing my own thing today.
Well, it's easier to move. What's the market cap of this company again?
55 billion now.
As opposed to what? $1 trillion? It's easier to push around.
Eric says, I think it's done after options expiration tomorrow at a 97 RSI. Yeah, dude.
Wow.
Wow. 100 RSI.
No matter what, even if it keeps going higher this year, which is very possible, by the way, there's going to be a massive pullback because RSI 97, how long can that, unless it's Bitcoin, I don't know how long that can be sustained.
Yeah.
Honestly, it's going to all depend on Nvidia, man. Nvidia can make this thing go even higher if Nvidia says, hey, listen, we got even more demand than we said last time. And so that would push that shit way higher. But I would not bank on that. I would not bank on that.
No. Definitely that's pure gambling. Not interested.
Yeah. Like this at this point, the thing that I've been seeing is you go to TikTok, you type in SMCI, and dude, it is just the who's who of clowns on there. oh, if you look at the PE, the PE is still, and then they compare it to NVIDIA, saying, oh, NVIDIA is this value, so this is definitely going to be this much. So we need to buy. And so now I'm finding that all the
It's
people
like those
that are buying
Palantir
now
folks, right? Who compare themselves to Microsoft and Google.
Yeah, the next $1 trillion company, even though they barely generate $2 billion in revenue.
Look, I don't say we're at $1 trillion, but I think Oracle 300 billion. I don't think that's crazy.
You don't think Palantir is going to get to $500?
Oh no, I've never said Palantir. There's some people that say I don't say that. Okay, Coinbase. Let's hear this from Coinbase, then we'll talk about that.
Coinbase shares were higher after hours. The company reporting a beat on the top and the bottom line. Kate Rooney's got the details. Hey, Kate.
Hey, Melissa. So Coinbase reported a surprise profit thanks to soaring trading volume in the quarter. Bitcoin markets recovered in the fourth quarter. That was a big help. Also helped by higher interest income. It earns interest on assets. This partnership it has with Circle. That was up 17%. As far as interest income, the company brought in $1.04 on EPS. That was compared to a loss of $2.46 a year ago. Trading volume almost doubled from the prior quarter. Coinbase still very much tied to volatile crypto markets, which could be a good thing in a bull run, with Bitcoin topping $52,000 this week. Here's what Coinbase's CFO said earlier on Closing Bell.
We've always said that crypto is a volatile space. And when we see increases in volatility, it has long attracted more trading volume to our platform. And that's exactly what we saw in the late fourth quarter.
Subscription and services revenue, which is a little more consistent and predictable, that beat. Coinbase said in press release as well that they gained market share, but they did not disclose a monthly user number yet. That might come later in the 10K. Also, the take rate, that fell almost 1% from the prior quarter. They're seeing a higher mix of professional traders, which tend to do more volume, but at a lower fee. Back over to you, Mel.
Kate, thanks. Kate Rooney. We've talked about this crazy recent run in Coinbase, and here it is up another 11%. KRIS, I'm curious, does the chart look sustainable in your view?
Well, I certainly think it behaves as a stock in a very established uptrend should behave. Remember, it's only a month ago. We're talking about a 40% correction. All it did was bring it back to the 200-day moving average. That correction was coincident with the launch of the ETF. It was kind of the sell the news type of event. We didn't even kiss the 200-day. We were there for an hour, and now right back to the highs. Good charts in uptrends don't even give you a chance to buy them when they're oversold. They go right back to the highs. It's exactly what we've seen here. I think you continue to carry on.
So Coinbase beat revenue by 140 million, GAAP profitable. They're saying they're going to be.
I just want to bring back. Do you remember when it was around 60 or even 30? I don't remember. We were talking about. I said Coinbase is going to all-time highs.
You did say that. You did.
Bitcoin goes up. Coinbase is going to all-time highs. There's no way to stop this.
And the ETF argument, this argument I brought up a couple weeks ago, like, yo, what do you think about the ETFs? The CEO is like, dude, ETFs are great for us. It doesn't stop any of the volume, and it just makes it keep. So
what do they have? 8 out of 11 or something? What do they have?
I think so. Or
custody, in terms of custody. Yeah, I mean, look, they're a crypto monopoly. If you're going to invest in crypto and not buy Bitcoin, who else are you going to buy?
Okay,
so something very, very interesting that's been happening in the background that they spoke about in Compound and Friends, which was very interesting. So GBTC, you know that they charge like crazy high fees compared to the other ETFs, right?
Yes.
You guys know that, right?
Now, I think it's 1.5% or something like that, right?
Right. Now you would think that people would be pulling their money from them, but they're not really lowering it that much, VITALY. And people are not pulling their money.
By the way, I have GBTC and I haven't sold out.
You know why?
Why? At least for me, because Bitcoin's going to the moon. What the fuck do I care about 1.5% over a year?
Okay, so that's your logic, but the logic here is that there are people that want to move to the lower cost ETFs but can't, because if they sell, they'll be triggering capital gains taxes and taxes. So it's like, okay, if I have to, what ends up happening is the taxes I end up paying is like 15%. That's about 10 years worth of gains that are just going to be taxed away. So instead, it's better just to hold it with GBTC. So Grayscale is fucking making money on all these assets that they had under custody, and people thought that they would rush out, and they're not rushing out. They're actually staying in, which is fucking crazy. Also, if you think about it.
I actually agree with that, but I'm thinking more along the lines of like, I don't want to be bouncing around, and some funds that I use only use GBTC. So for example, I have Wealthfront. They only buy GBTC. So I don't have a choice. So do I care about the 1.5% in terms of in this case, no, because I know there's a top coming and that's when I'm selling. Do you know what I'm saying? So I don't care about the 1.5%, even though, yes, technically it should matter to me.
Bro, I fucked up, man. I have so many short-term capital gains this year. I'm gonna get raped by
dude,
Uncle
Chris,
Sam.
you've recognized a lot of profits early in 2023.
I mean, it's fine, dude. I've been in positions before where the tax part has caused me to lose money. So now I'm happy just to give the money to Uncle Sam. Like, if I know that we're headed for a technical top, it is not a good idea to be in it just because, like, oh yeah, you know what? I don't want to pay Uncle Sam an additional 5 to 10% in gains. Dude, if you see something and it's not, it's topping out, just get the hell out of it. Don't worry about the capital gains.
This is what I was
gains.
If there's money on the table and you're up, take the fucking money. Okay.
Yeah.
He's right about that.
Because someone asked me this on the Market Open, and I just preached what you guys told me like many, many months ago, which is that taxes cannot be the reason that you're afraid to sell something, right? Like,
yes,
you want to optimize, but that cannot be the reason you're not taking your profit.
Absolutely.
Right? This is what I did with SoFi, right? I was up 30 grand on SoFi options, and my perspective was, well, it's only been 2 months. So instead of me being like, oh, it's 2 months, I'm up 30 grand, I should take the fucking money, I was like, I'm gonna have to pay taxes and I could be more. And so, like, but the real mentality is you don't get opportunities to be up 30 grand. You should take the money and just, even if you give half of it to Uncle Sam, whatever.
Because options, as we learned, disappear. The profits from them disappear if you don't take them. And that's why I sold half of the ClearSpark calls, even though I do believe we're going higher, but not to take a 200% profit in, like, I don't know, what's it been, a month and a half, 2 months? It's been something stupid.
You're up 200% on CleanSpark?
I'm up 200%. Yeah. In the calls, and in the shares, I'm up double.
So walk me through your psychology. You could have held them for a while to avoid the taxes. So why did you at that moment? Why was it not even a question to you to take profits?
I mean, 200% is a serious amount of money to make in, like I said, in 2 months. It's ridiculous. To not take that is like, I've learned my lesson over years that when I don't take the options money, not the shares necessarily, right? But when I don't take the options, that floats around too much. That money disappears really fast if you don't grab onto it. So you really should take that and not hold out that contract, even though I have a 2-year leap, by the way. So.
Okay. And then Chris, your argument for why paying Uncle Sam is better? What would be
because there have been times, just like VITALY said, where something fundamentally could change in the market and now your entire gain can turn into shit. And the thing is now, unlike stock, you can't just hold until it comes back. You're going to get timed out. So, if you're doing options, believe it or not, I do options in my IRA, which is technically risky, but because, if you lose, you lose. You're not really going to gain a lot of benefit from that. But also the benefit is you could do a lot of short-term moves in your IRA and not pay any taxes. Like the amount of cap gains that I have in my IRA is fucking staggering. I already have an exit plan too. What I'm going to do is I've built up such a big IRA position now that now I can probably retire in the next 5 years. And every year I'm going to take a portion of it and I'm going to convert it to a Roth. And then what happens is the Roth grows tax-free. So what happens is after 5 years, you can take out that initial that you put in there without paying any taxes on it. But the thing is the gains are going to keep compounding. So what happens is now my traditional is going to keep growing. And every year I'm going to pull some of it out and put it and convert it to Roth. And by that time, I won't be working. I won't have any additional income, which means I'll still have to pay taxes on that traditional to Roth conversion, that you're doing. But because my taxable income will be so low, I don't care about it that much. But I still have a long time to go in terms of retirement. So all the money that I do put into my Roth, it's going to be growing tax-free.
And the money in your regular IRA, that doesn't grow tax-free? Only in your
No,
Roth?
that grows tax-free as long as it's inside.
Okay.
So if you're young, actually, so the mistake I made is I did a traditional IRA for too long. I think you should sort of mix it up. Do some half traditional.
No,
I
didn't.
I'm
I'm
talking about AMIT.
Yeah.
I'm talking about AMIT.
Oh yeah.
I'm not sure if you're doing Roth IRA, but you should do that because like you get taxed on the income you put in. But if you have a long time horizon for some of these plays to work themselves out over 20, 30 years, imagine the compounding that can happen. It'll all be tax-free because you've already paid the taxes up front. So that's why people should do at least half Roth. So that's what I'm doing now. Half Roth, half IRA.
This is a good question. Blackbeard says,
Traditional,
what,
meaning.
what would you both say is a safe percentage of stocks and options in a portfolio?
It depends on the market. When the market is super undervalued, like when like last year when you saw like tech companies with PEs in the single digits like Meta, dude, that's when you take the risk. You go risk on. When the market is absolutely dog shit, you go risk on, take on options, whatever. And then the minute that market becomes overvalued, go back into stocks and just stick to stocks. So just mix it up. You can have, I would say, never go beyond probably 40% of your total portfolio in options. I mean, and that's risky. I'd say most people shouldn't even do more than 15 to 20%, to be fair, you know. But if you want to take the risk, like I would say 40% of my portfolio last year was in options. And now I'm slowly going more into stocks and just letting the stocks do their thing, you know. I'm actually taking profits and going into indexes now too, because I see the market's frothy. I'm not too optimistic about getting the value plays that we did last year. You know, now you really have to dig down deep and search where last year you could have just pretty much took a dart and thrown at a dartboard and you would have gotten, you know, a great amount of return.
Like buying options on Meta at 480 is not the same as it was at even 200.
No,
Right.
I would say that's not worth it. But I'd give a counterpoint. I don't agree going into 40% options, by the way. I would say you should be 95% stock for most
99% options. That's what you're going to say. That's your
95% stock for almost everybody who's listening right now. Absolutely 100%. Very few people should be more than 5-10% in options. And I'll give you a good reason.
Yeah.
Because let's say you do 5% and you went long Meta, you would be up 20x. So your 5% would be like 20-30% of your portfolio at this point. So it would become very big, very fast. You don't need to go 40%. And yes, there's a lot of opportunities, but sometimes when you're trying to get rich fast, you lose a lot of money. So just remember that not everything always works out. And I don't want you guys to think that it always does.
I'm gonna put on my big brother hat real quick. And it's something that, Amit, I'm going to criticize you about, but it's totally worth it because long term it'll save you some money. You are going a little too heavy on the options, my friend. Like, bro, you just I saw your live streams and you are just options king, dude. And I'm like, $25 calls.
Robinhood is the big position with options. That's true. But I sold out of most of the other options. Google were out of it. Palantir were out of it.
Yeah, no, and I'm not criticizing you for going into options. Just make sure that your position sizing isn't that you take such an inordinate amount of risk that, believe it or not, your DD can go complete to dog shit if the economy turns over. Like, imagine all the people that bought options thinking that, hey, everything's going to be great in 2020, 2021, and then COVID happens, and now, boom, you're out. So just be on the cautious side with that. That's all.
So this is why, like, even Clean Spark, which I don't plan to hold long term, by the way. I told you in the beginning, that's just a play on Bitcoin, which I care about, which I've been holding for basically a decade. I still bought a lot of shares. Not all options. I still just bought a lot of shares, just in case something happens, options get wrecked. I just want to participate, not with a time frame that that options give you, if that makes sense.
Yeah, I think that's fair. I think for me, again, it's really a lot of cheating right now. It's like, all right, and it's the wrong mentality, but it's also a little bit of, okay, is there a short-term opportunity here for something that's undervalued and you go in? Like, I wouldn't do options on something like a Facebook or so, like even VITALY buying $300 calls on Amazon. I don't see that like making sense because Amazon
it's a 2.5 3x right now. But anyway, that's not enough for you people.
No. What I'm saying is, like, if I wanted to buy $300 calls for June 2026.
$300. I'm not buying $300 calls. First of all, even if KRIS, I'm sure KRIS take a look. If you look at a spread from 2 to 250, I looked at it recently. If you're talking options again, 2 to 250, you put, I forgot what the cost was, but the upside is roughly 250, 300%, and it's going over $200, in my opinion.
Why not just buy the stock then? That's my point. Because if
I have both,
that's what I'm saying. Like, if the options are super, because what I'm doing is I'm buying leaps and I'm trying to get out of them 18 months earlier or 14 months earlier.
The amount of stock I have, actual value of stock, is way more in dollars than the amount of options I have.
Because you have a very big portfolio. That's the thing.
That's fine. So, but I'm saying you don't have to buy crazy out of the money. Like buying $300 calls on Amazon, I think is dumb. I'm not.
Oh, that's
doing
what I thought
that.
you were doing. That's what I thought you were doing.
No,
Okay.
I'm not crazy. I'm looking at, first of all, I have calls at $100 when it was $100. So I have calls still 100. I have 120. I'm at 30 strikes. I have 150 strikes. I just kept buying it as it was moving up. Now I'm looking at 200 to 250 spread, and the upside is like a 2.5x between 200 and 250, something like that. Maybe 3x. Yeah. I mean, that's a lot of money. Imagine you put 10,000, it turns into 30,000. I mean, that's plenty of money. It doesn't have to be crazy. You put 100 grand in and you make $1 million. I don't need that to happen to everything. Sometimes it's nice to know that I don't have to worry about Amazon, you know?
Yep.
Yeah. No, I think that's fair. I think it's
actual shares. And I do have a lot of shares. Okay. And Enphase, I have a lot of shares.
And you're up a lot this year, right? So far.
He is. I heard he said his figure.
I sold a lot of Robinhood yesterday. I mean, I sold almost.
Well, what did you start your portfolio with? I'm curious. What was your initial outlay, and now what is it at? I think you shared it already, but if you want
like initial in what 2019?
No, right? Well, yeah. What did you start with, and all the money you invested, and what are you at right now?
It's been, dude. I started with like 90, and it's at like 150-ish over 5 years. But that was after 2022. We went down.
So you started with 90 grand and you're at 150 now. Is that what you're saying?
Roundabout, yeah. Roundabout.
Okay.
But that's over. Remember, that's over 5 years. Now, a majority of those gains came last year because 2022 shit the bed, right?
And how much of your portfolio was in options? Be honest. I mean, actual value, dollar value.
Dollar value. I would have to check a dollar value. I think it's closer to 70 to 80% though. No, not 70. It's around 60 to 70% because Palantir is the biggest holding, right? So that's just a ton of Palantir.
Right. Well, I fear what can happen is, things work out could be a long time, could be a year or two. And then you get comfortable, like a lot of people in the chat might get comfortable with, oh, these options are working. Everybody's so smart and making money. When things turn around, you will not be prepared. You will not be prepared for it. Believe me, because I've been in these situations. I already know, and I was not prepared and I lost my shirt. So the same thing is going to happen to everyone in this chat. I'm not excluding anybody. If you keep gambling in this respect, because at some point the luck runs out. It is not forever. I'm sorry to tell you that. That's why you you participate in the equity of companies, because, hey, if the luck ran out and you're willing to hold it, a good quality company, then you can wait 5 years until it recovers. You can't hold an option for 5 years, buddy.
No, that's true. But I see like when I bought Robinhood options at $8, the idea is like.
And what happens when it hit 14? Why didn't you sell half of it immediately?
No, but first of all, it didn't hit 14. It hit 13, then it came back down. And I sold 37% of it, right? But the point I'm trying to make is, but the point I'm saying is all these options expire in 2026. And the goal is to get out of them by the end of 2024.
I know. But look, anything could happen. And your options have gone up a lot, right?
No, they haven't.
Well, from $8 to, you just said $8 to 13 and change. Well, what are you
up? They're up about 50%, I would say. Yeah, at one point they're up 70%, but they're not. I mean,
that can't be right. Really?
So the volatility. So remember, these are 2026
because he bought them so fucking far out. That's why I wanted to criticize you, bro. Why would you buy $25 Robinhood fucking calls?
So I looked at the delta, right? I bought them at 52 cents. Robinhood getting from $11 to $14.05 would make that worth $1. That would be a double. If Robinhood went up, what is it, 25%? Robinhood
hold on, you got
there, got to $13.90, and then it came back down. So
this can't be right, because if you bought it at $8, okay, and it goes up to 13, 14, that's, you said that's a $5.
Yeah, but first of all, there's two things.
$7 delta.
No, but it's a spread, so it's not a naked call. Otherwise, yeah,
you bought another spread. Oh,
correct.
God.
Second of all,
what was your spread? What was your spread?
15-20.
But by the way, this is the reason spreads suck, which you're pointing out here. If you would have just bought a call at whatever at $15, you would have been up the $6 per share, which would have been like 600%. Well, look, if your thesis is Robinhood is going to $20 and you're buying a $15 call at $8, no, I mean this.
But it could have decayed too. So if this didn't work out, it would have decayed, and he would have had to put up a lot more capital. He didn't have to put up a lot of capital.
I actually feel sometimes you have to do that. You can do both, but you just missed out on a massive opportunity. Like massive. You would have 600%.
Yeah, but I also decreased the downside risk, dude. Like if it decayed or if Robinhood fucked up on earnings, Those calls would have been way worse than if there was a spread where I had some protection because I had sold the call.
I like when the gambler is trying to minimize his losses.
Look, I get what you're saying. My point is just if these are way far out and my goal is to get out of them. So the mistake I made on SoFi was I was like, oh, I have so much time. I'm up so much money. And then I didn't get out when I was up big. That I learned from that. Now the goal is that's why I actually sold Robinhood calls and I wasn't a degenerate and just let them keep printing. And then Robinhood goes back to 10. I'm like, no, let me take profits here, just like you did on CleanSpark. Let me XYZ. I took profits.
And I sold my Robinhood too, as well. And I had pure calls. So I was up 50% on the calls after only like another month.
Here's my recommendation to you, Amit. Take some of those gains and put them into some great dividend payers right now while they're paying really good dividends, and they're going to keep paying you good dividends. And you'll see capital appreciation and you'll see a fixed income coming in. The reason why I say that is because those companies will float you during the bad times.
Yeah.
Right. When the bad times come, you don't want to be in a position where your income is so dropped off that now you can't recover. So right now, that's what I'm doing. I'm making gains on certain positions, but I'm taking them and I'm putting them into some really good long-term things that I think are going to do exceptionally well and that are paying a really good dividend. Why? Because I want to create an income stream. And right now I've created enough of an income stream where I can comfortably say if my options positions were to go to zero, I would still be okay because I still have this income stream coming in where I can keep building more and more and more, you know? So as a young person, one of the greatest things you have is the ability to compound your returns and using drip. And right now you're very lucky that interest rates are high, which means that a lot of these companies, their dividends have to kind of be higher just to keep up with the Fed right now. So the minute that the Fed starts cutting, all those companies, their assets are going to be bid up because now they're going to be competing for yield. You know, do you understand what I mean by that?
Yeah,
kind of.
Yeah, and that makes a lot of sense. Like getting into something that's either paying a dividend or something that's like boring, like I know that's a big one for a lot of people. I know some people hate it.
I have that VC properties, you know,
VICI, yeah, VICI.
VICI.
So I guess here's the question then. The reason I'm so heavy in options is because the goal is to kind of cheat a little bit, get a lot of gains quickly, because in the stock market it takes time to get gains. But if you do it with options, you can leverage your alpha quicker and then get into what KRIS is saying. What would you guys say to that mentality? Is that mentality wrong, or is that mentality kind of?
Let Jack respond, but I'll tell you it's wrong because you should build a separate portfolio that you can ignore for 30 years and just keep building it. And if you just DCA slowly over it, you don't go crazy, whatever, 100 every 2 weeks or whatever, 500 every 2, whatever you can afford, obviously. You just keep doing that. You ignore it. You don't pay attention. And a good way to do that is with M1 and those pies where you just set up either 10 companies, you Verizon, VICI, whatever you want. Leave them alone, all the indexes. Just let M1 handle the separation, because as soon as you deposit the $500, it basically splits it up based on your pie. I don't know if you've seen that, but it's automatic. And it's just brain dead simple. And if you lost $500 every 2 weeks and you didn't buy options with it, you would still survive. Your life would go on. And in 30 years, you have a complete backup that you don't have to worry about. And if you don't need that money, congratulations, give it to your kids. But I bet you anything, you're going to enjoy having an extra the 10,000 in your pocket every month.
You know what the best thing that you have that me and VITALY don't? Time. Yep. You have the ability to compound.
Hilarious humor skills, but
you know, the best thing he has is the scarf.
You know, and I hope you didn't take this as us trying to come at you for like
it's good. It's good.
I'm still buying dividends. I don't need to buy dividends. Okay. It pays nothing. It's very low, but it's just nice that there is something that comes in, whether I do anything at all every month or not. It just comes in. And that's nice in the back of my mind. I feel good about it. And one day, maybe I will need those dividends in 20 years. And I don't have to worry about how do I pay this and how do I pay that? Well, I have this income coming in, whether I do anything or not. So that's what you need to create, an income stream, whether you work or not. That's what's important here.
I agree. Well, one thing I do want to say here, though, is, and I got this in my chat a while ago, is like people are saying, oh, you should never talk about options. That's what I vehemently disagree with, because options are incredibly complicated. I get that. So is computer programming. But like to tell someone who's interested in the markets or interested in computers to not give themselves a shot, even if it's on a paper trading account, even if you start with $1,000 or $2,000 and just play with it and learn it and not have access to that knowledge or try. I think is a disservice to people that are in the market. Like I disagree with you just go long forever, you buy stocks and you hold them. There are other ways to make money in the
it's fine
market.
for
There's nothing
you.
wrong with trying to learn some of those skills, even if you don't YOLO.
Hold on, it's fine for you because you spend all day talking about stocks. Most people do not want to talk about stocks all day, and if they go into options, they're totally screwed. Okay.
Well, but it's kind of like if you have a 9 to 5 and you want to start a side hustle, your side hustle could fail. Does that mean you're not going to spend from 5 to 9 learning about how to start your e-commerce business? Like, no, from 5 to 9, you watch some YouTube videos, you learn how to do some options, you play with $5,000, you try. Like, if you're dedicated to trying to learn, it's not the worst thing in the world. I feel like that's.
I would say his audience.
You know?
No. Look, the reason why, and trust me, I will speak about options, but I hate speaking about options, not because I don't think they're worth it, but the problem is there are so many complexities that come with options that you don't have to deal with when it comes to stocks that can really, really throw people off. And the thing is, the cost to learn that stuff can be rather expensive, you know? So,
I agree with you. That's why I think the mentality has to be, you start with a very small amount, or you just paper trade, go to Market Watch. They have a full, or Robinhood, they have full paper trading account. And second of all, at the end of the day, dude, like life is hard. Like you got to do some crazy, things are not easy to learn. Like
I had this conversation with somebody who was like in their 50s and said, I want to get into options trading. And I told him, just don't do it. Don't do it. They have already been very successful. They've got over a $2 million portfolio because they've been investing since the dot-com bubble. All right. They've been buying things and holding them, but they just see other people's returns on Twitter. Like they see like Jesse's returns. They're like, oh, I need to do this. I need to pile in. I need to buy $100, $140 call option on PayPal. And the thing is, they're very new to this, but what's happening is the greed centers in their brain is starting to fire off.
That I agree. The greed can go crazy.
And the addiction, because remember, this is still gambling. No matter how much DD you do, it's still gambling. That addictive feeling of gains can really, really like step in there. And literally, you might have to go to like one of those Las Vegas like gambling addiction hotlines. You ever seen those? Right.
Yes.
So
just remember.
Yeah.
No, Chris, I agree with you. Just remember, if you would have just bought, obviously you're not me or Chris, if we would have just bought Google or Amazon or whatever, 15 years ago, we wouldn't need to do any options at all.
Yeah,
it's
exactly.
It's just the way it works with great companies. So you just have to give it time. That's the one thing obviously people don't want to do is give things time, but there are plenty of great companies that we discuss all day long. You buy 5 of them, you hold them, you don't do anything, you don't do covered calls on them, you don't sell puts against them. You just leave them alone and you wait. I know that sounds so simple and it ruins the channel. Okay. But that's the secret here.
So one thing, Amit, there's someone in the chat that said that was a bad move, Chris. You're never too old to learn how to trade securities. And the reason,
go ahead.
When you're at that age, you should not be taking more risk. Options are very risky. For you, Amit, I think you are a good candidate for options. Why? Because if you blow your account up, you have 30 years to recover. That person does not have 30 years to recover.
I agree with that.
So you don't want to be in a position where you're 50 trying to retire, and now you were going to retire at 60, have a great life, and instead you blew up your account and you have no possibility to recover. Older you get, the more fixed income, the more risk off stuff you should be doing.
Okay, let me ask you guys this question. Let me ask you this question. Let's say someone in the chat has like 70 to 80% of their portfolio not in options, not in stocks, but in Bitcoin.
In Pokemon.
or Steve with alternative assets. How would you advise someone who has, forget 70, 80%. Let's say someone in the chat has 20%, which is a hell of a lot of percentage of your portfolio in something as speculative as the decentralized nonsense that is Bitcoin. What would be
that's me, by the way. So are you talking about me? Or are you talking about
you have a very big portfolio. I'm talking about someone who maybe that doesn't have that big a portfolio, but a significant part of that I mean, you can afford to lose all your crypto. You'll be fine.
I would not want to, but yes.
So what would you say? Also, okay, yeah. So let's talk about that first. How would you advise someone? Because you're saying options is gambling, which I get, and you guys are right. What about crypto? How would you advise that?
Look, first of all, I think under 20% is totally fine. I actually don't think that's too much because I always say, look, have 5, maybe 6, whatever you feel comfortable with, big bets. So if crypto goes to zero, like you pointed out, I don't go to zero. That's important to me that I don't go to zero, especially as I get older. I don't want to go to zero, right? And Matt Money would chime in here, right? Everyone's going to zero, basically. So if crypto fails, goes to zero, who cares? If Tesla fails, goes to zero, who cares? If Enphase fails, goes to zero, who cares? Well, Meta might save me, right? Or Amazon might save me because I have those 5 or 6 big bets. Plus real estate, obviously, I'm not even talking about that, but there's no one thing that should be able to take you completely out of the game. And it's fine when you're younger. I would say fine when you're 22. If you do have 50% of your portfolio in crypto, you're willing to get blown up. Okay. But just remember that it's going to happen eventually. You will be blown up. I was blown up. I had to suffer. I think I went through this story over before. I'm not going to do the whole story again.
We both spoke
I have blown up my life.
It makes me feel like I'm going to get blown up because Chris got blown up. I'm the only one who hasn't been blown up.
You're going to be blown up.
I'm going to save the Finance Junkies pod and not get blown up.
No, everyone
we're trying to help. Look, everything we're doing, we're trying to prevent you from getting blown up. Though we don't have as much confidence these days, because when I tune into your streams, I'm just like, this motherfucker right here, bro. I still remember Vitaly. Did you check? Did you see him and Bergman with their PayPal? Did you see that?
You didn't see I went viral on Wall Street Bets. Can we play that clip?
Yes, you gotta play.
My point is, I just want to answer your question. Play the clip, but look, when you have those 5 or 6 bets, no one bet will take you out permanently, assuming they're sort of in different sectors, of course. And you should do that. And I consider real estate also a different sort of sector. So you cannot, or you shouldn't, I'm not going to say cannot, you shouldn't go all into one thing, including crypto, even as it's going up. You're just being super dangerous, because what ends up happening, and I've done this, is where I rode it all the way up and then I rode it all the way down. Because
what would you say?
You think the gains will never end. And then when the pullback comes, you think it's temporary, because I've seen it before. It's always temporary. It goes back up. And then 4 years of your life gets destroyed. That's what happens.
Danger says, if you believe that Bitcoin is the safest asset out there, then 80% doesn't sound irresponsible. Chris, what would you say to that?
His name is Danger.
Because I understand the critique you guys just gave, and I'm not trying to downsize it. You guys are totally correct. But if someone has 80% of like how could you not have the same critique for someone who's heavy?
See, hold on. Ren is wrong. Scared money. No, 5 big bets is not scared money. That's highly concentrated. In fact, I don't think that's scared at all.
Okay, so is 80% of Bitcoin good or bad if someone believes it's the safest asset?
The problem is, what happens is they're going to go 80% when it's 150 grand, because the thesis cannot end. That's what happens.
What if they went 80% at 15 grand? Then is it okay?
It's a little bit smarter. Let me put it. When nobody wants it, that was a smarter time. But then
that's kind of what I did with the Robinhood options when no one wanted them.
You should be right, but you should be selling on the way up. You have to be getting rid of some of it on the way up to at least get back.
Sell some of their Bitcoin on the way up from 15 grand.
Absolutely, get back at least your initial investment. Don't be the fool that leaves it all on the table.
Someone's calling out Sachin, which Sachin went fucking all in on Palantir.
No, but that paid off. That paid off. That worked.
I know, bro, but that's the thing.
Did it? It was 2 years later, maybe, and who knows how much he held of it. I remember that episode.
I talked to him personally, and he's not 100% anymore, but he was until 22.
And he suffered for 2 years to.
But you gotta suffer in the markets to get gains.
No, you don't have to. That's
you just said you have to wait for a long time to
No, you do have to wait. The thing is, you don't need to suffer with 100% of your portfolio in one thing and then have it turn against you. Isn't that
what you did with crypto, though? That's literally what you did with crypto in 20.
And I said I got blown up.
But now you're super rich because you went through the suffering of those 4 years.
Not everybody will have the same situation. Okay, the only reason I survived was because I never went into debt. That was a smart thing I did, where I was able to hold my assets and still pay my mortgage.
And you married someone who backed you and didn't just divorce you and say,
actually, you're right. She's happy you're mentioning this if she's watching this. She was working and doing well, and so somebody was there backing me up. If I was all alone, I would be bankrupt. Okay.
Yeah.
So everyone gets blown up eventually, and it's going to happen to you, and it's going to happen to everybody in the chat.
Why are you saying
it's not going to happen to you? It's not going to happen to you. No, I will fucking come to New Jersey and take your phone and just change your Robinhood password, bro. I am not gonna let you get blown up. I don't give a fuck, bro.
You can't
I'll
stop
call
it.
you in the middle of the night. I
stop
can't.
it.
No, I am gonna stop him. That's why I'm calling him out publicly. I could
Okay,
have
so
done
hold
this
on.
privately.
Let's do it.
I won't let him do it.
Let's do a question right here. Okay.
Mhm.
I have $25,000 in TFC options. Okay.
Mhm.
They are up 70% or whatever.
Keep them. You good?
You
good.
Because I'm like, these bitches are 5xing, bro. They're gonna
We good, bro. TMC. Fed is gonna cut rates. AOCI loss is gonna go down. We
Hold
got
on.
this made in the
Guys,
shade.
this is what I
bro.
deal with. He's so responsible on the pod, and then when we're texting, he's like, "Nah, just keep the options, dude. They're gonna be fine."
They
It's
are
simple.
fine. You're gonna do fine. I am the one that did the DD. Don't you know what they say, right? Always trust Chris. Chris doesn't lose money, right? You're gonna be fine with TFC.
Oh
bro.
God,
Just
that's
letting you
those
know.
famous last
I
words.
like
we've
that.
heard
That
here.
sounds like he says, "Hold." I'm like, "All right, oh, I'm holding, Daddy Chris. We're holding."
Look. I usually am the guy that sells out way too early, right? So if
That's
I'm
true,
telling
that's
you
true.
to hold it, you know what I'm saying? You know what I'm
Well,
saying?
why don't we bring up this thing? No, this is actually a great segue to a picture you posted this morning that you got some shit for, by the way. Whereas you made 100 grand on SMCI, is that correct?
Yeah.
Okay, if you had held this 1,000 shares, 1,100 shares, you would have $1 million. A lot of people in the comments were like, "Oh, Chris, did you learn your lesson from this or something?" Right? They were trying to like one up you. What is your response to the people that are saying, "Oh, you should have held yada yada"? What is your point?
Well, I mean, look at the chart. The chart will explain everything. Basically, the fair value of this company was like $200. I noticed that when it was $90, that was undervalued. So the minute it got to the valuation that it should have been, I was like, okay, you know what? There's not really much juice left to squeeze. So if you right now, everyone is looking at this God candle and saying, oh my God, this is you missed out on the gains. But go back 1 year and you'll see exactly what the fair market value was for this company. This is a low margin hardware business. Right now, people don't understand that. They're just looking at top line revenue and going absolutely bananas right now. So do a 1 year chart for this.
1 year. Yeah, that's insane, dude.
Right?
You
So
said about it.
Right? And it went all the way to 200 something and it stayed there flat because that's what the market was valuing. I don't know who got a hold of this craziness that just skyrocketed and that's where it is now.
This could be an artificial, it could be a pump, honestly. Somebody was pumping it. The market took over, algorithms took over. But
Bank of America upgraded it today. It seems like the street also wants in, right?
I wonder if when they start upgrading, that is a very scary time, by the way. Analysts are the worst at predicting shit. So as soon as they start upgrading even higher, I would not believe them. I would start offloading. Maybe not everything, fine, that's fine. But look, once again, take half off the table. It's not gonna hurt you. You're up fucking 10x.
Yeah, no, I think it's a good point. I think a lot of people are trying to give you shit on it, but dude, you made 100 grand off of whatever you put in.
And it was in a very short period of time too. So,
yeah, it was 2 months.
The one mistake that I do have to acknowledge is that you can always keep a little bit, like keep at least 10-20% as a spec bet and then let the rest run. I mean, I didn't have to take
that, Chris.
100%. But you know what it is? It just sometimes when you see that full position already done and your price is already done, you're like, there's really not much juice left to squeeze on. I'd rather just take the capital and park it somewhere else. And believe it or not, I've done well using that capital that I did gain on other things. I mean, it's definitely not as good as what SMCI has right now, but that's one of the chances that you take. But I think I'm incorporating that more into my investing now than before, where I do still keep about 20% in certain things, even after I'm sold out majority. Like I still have some meta. I don't have a lot of meta because I've sold out most of it, but it's nice to see it. And it's like, oh yeah, look.
Let me ask this question, and then we'll end off the pod with the PayPal video. So what is your philosophy, both of you, on exit strategy? Let's say you're in a stock or you're in options. At what percentage, at what tranches do you exit the position over the course of a year or 2 years? Like, how do you fully decide to get out of something, whether it's stock or option?
If I have I'll go first really quick. If I have a double on my hands already, I will take my initial principal out. I don't give a fuck what the price is, how much more I can go. I will take my principal out. Why? Because now the rest, I feel way more comfortable just letting it ride and do its thing. And I can use that capital for something else that's a bigger opportunity. And then if it doubles from there again, I'll probably take another 25% out. right? And then I'll probably go after that, take another 25% out, unless the stock just goes parabolic for no reason, in which case the valuation's already triggered my high. Then it's like, fuck this, I'm going to sell the entire position, which is probably the mistake that I made with SMCI.
So like Verizon right now, you're doing well in Verizon. Your plan is to, as you keep progressing, just
I already did. I already sold my $40 and $50 spreads. I sold them already. Some of them. I have 45 and 55s, but that's what I do. I usually sell some of my position, take a little bit at the higher end because I think Verizon's going to get to 55. But the money that I got off of Verizon, that I got off of Amazon, because we sold last week. Right now, a good majority of it is sitting in cash. Some of it went into Celsius, which is also done fairly well. But
wait, you sold Amazon?
Some calls. You sold Amazon calls.
Some calls. I had spreads on Amazon, so I sold.
So you sold them off. I got it.
Yeah. So,
Vitaly, what's your philosophy on how you?
Well, so it's per whatever the ticker we're the company we're following. So, for example, Tesla. I mean, 1 trillion I should have sold. I've said this. This was a big mistake. My exit strategy in the beginning when I bought at 40 billion was to hold it to, I don't know, I figured it would get to 300 billion, 400 billion. But then it just shot right past all of that. I didn't even have a chance to really process it. It just went super fast. And when it got to 1 trillion, I think I was too dumbfounded to even sell any, which was a big mistake.
Meaning you thought it would go to 3 trillion, like you just thought it would keep going up forever, basically.
Like I don't know what I was thinking, but it was just very poor analyzing of the situation.
Oh,
I'll admit
one thing I forgot to mention, really, sorry to interrupt. I usually just buy the underlying stock. Once it gets to like more fair value, just if you still think that there's more juice to squeeze, just buy the stock. Like for you with TFC, if it runs higher, you can consider selling some of it and buying the stock and basically collecting the dividends and riding.
It's a good stock to have long term. It's one
right.
Put it in your divvy portfolio or split up the gains amongst multiple divvy stocks.
The current yield is almost 7% per year, which is what the S&P usually just yields, and their dividend grows over time. So keep that in mind.
Yeah. Well, in terms of holding it though, for the majority of things, I don't think a double is enough. If I'm investing in it, I think it's probably doing more than a double in most cases, right? So usually it has to be over 3-4x before I start to take profits. And that's the reason I say 3-4x is because at 4x, then if I sell 25%, then that's my initial capital. And then everything else is, if I'm keeping it, keep going up basically. So in terms of Clean Spark, it's an easy thing. My target was around $20, by the way. I think we talked about this.
Yep.
And it hit 18 and change or whatever it hit. And I'm like, well, that's pretty close to 20. I'm not going to try to be nitpicky about not maximizing my return. I mean, it was 200%. That's plenty of return. That's why I sold half. So I got my initial capital back. In fact, more than my initial capital. So the rest of the Clean Spark calls are all free now.
Right.
And then now I can ride the rest to whatever Jesse thinks, $80, $90, because it's all a play on that kind of stuff. So, but now I haven't paid for it. Isn't it amazing? It's all free.
House money. Yeah.
You wanna learn something that other YouTubers are not doing that's actually worth exploring. And since you're young, you can actually still learn. Learn this right here. This right here, bonds, preferred shares, things like that. Those are things that other YouTubers don't even talk about. Yeah. But right now, there's an opportunity for asymmetric reward. So right now with Tellurian, me and Matt spoke about this on Cash Flow Chronicles. Basically, this is a baby bond that was issued by Tellurian. It generates an 8.25% coupon with a liquidation value of 25. The really, really cool thing about this is that one, you get a lot more security because it's a bond. So you're above the equity shareholders. And as the company's fundamentals recover, the bond appreciates in value. And at the same time, you're still generating income that the bond keeps paying out. So unlike other things like dividend payers, Verizon, all these other guys, they could just cut their dividend and say, you know what, we're not paying our dividend, or we pause our dividend. With a bond, they can't do that. It's an actual coupon.
What's the risk to investing in a bond like this? The company,
it's less risky. That's one of the things. And even when the company goes under, you have priority in getting repaid your principal amount. Sometimes you get very lucky and you can actually buy things when they're distressed. And then as the company recovers, you can actually do very well because you'll get the capital appreciation from the return back to the what is that thing called? The face value. And you'll still be collecting the interest payments along the way. So Tellurian is a natural gas company. They have upstream assets, but they're trying to build out like a LNG processing facility. They've had a couple of bad years, and some of their what are they called? Partners kind of bailed on them, but they still have really good assets, especially upstream assets that are cash flowing. So a lot of people didn't recognize that. And so me and Matt were buying this up around $10, $11. And now we're up 40% on this position. And we're still collecting quarterly interest payments, So these are the kinds of things, like I said, YouTubers don't necessarily talk about. But
so on a bond, you get, well, it's interest payments, not dividend payments, right? You said interest payments?
Interest payments. Yeah. Yeah. The thing is, interest payments can be quarterly or semi-annually.
How much what's the interest on that bond? Did it say?
8.25 with a 25% liquidation value, and it's trading. When we bought it, it was trading at around 11. So we got a 30% return from just the capital appreciation, but we also are now collecting every quarter. We just got a dividend payment interest payment, I think a couple of weeks ago, right? So if you think about it, you're getting paid 8.25 on the face value, which is the 25. So if you bought it at 11, you're getting 2.5 times that. So you're almost getting on a per quarter basis, probably like 4% per quarter in just return.
It's pretty good. It's pretty good.
The bond goes up if the company does well, right? That's still And the bond is like debt essentially, right?
It is debt. Bond is a debt. Yeah.
So you're buying their debt.
Yes.
Okay. Got it.
Yeah. So right now, there's a lot of opportunities in the CRE debt market that not a lot of people talk about, but I have some positions in, because what happens is a lot of people say, oh, you know what, commercial real estate is dead, blah, blah, blah. I'm looking at it and the bonds are trading at like way below face value. So even if, let's say, the thing gets liquidated, the bonds actually they stand in a higher tier of return in a bankruptcy situation. So all you have to do is just pray that the company doesn't go bankrupt, and eventually it goes back to
that's all you have to do is pray.
Hey, that's the name of the game. That's the name of the game.
I actually, I like where Chris is going with this. It is definitely interesting, but the problem I find with you're a true investor, Chris, because, and I say that not a trader in terms of that, but you'll just invest in anything that makes sense. That's what I mean. And for me, that's hard to do. I'm not sure if Amit can do that too, because we have to be interested in following it almost on a daily basis.
No. So this is where
it's hard to get excited about a bond.
I need to tweet my screenshots about CleanSmart going up, dude. I need to tweet it.
No. Let me explain something. If you want to do really good fundamental DD on a company, you have to absolutely understand how the capital stack and their debt stack works. Because if you don't understand that part, you won't understand what the real value of the company is. You have to go into the nitty gritty debt and say, okay, you know what? This is what the cost of capital is for this company. This is what they can do. Can I buy an option on a bond?
Hold on, this is true. Can I buy an option on a bond? How do I short this bond?
Spread on these bonds.
Oh, geez, man. Whatever.
No, but Chris, you're right. And this is where I respect Chris a lot. It's like understanding the actual, like the internal idiosyncrasies of like a company, like their fucking capital debt structure. Like, I don't know that about Robinhood. Like, I know Palantir doesn't have any debt, but like that stuff's very valuable.
It's impressive, man. It's really impressive.
I'll tell you.
Once again, you have to know who you are as an investor too. So
yeah. So as an example, like this whole thing with Verizon, one of the things that made a lot of people sell Verizon off to $30. Anytime I would ask someone, like, why aren't you investing in Verizon? You know what their response is? Oh, they got too much debt on the balance sheet. And then they would just end it right there. And I'm like, okay, here's a question. What do the maturities look like for these guys? Oh, I don't know. And I'm like, it takes 2 seconds to go to an SEC filing and look at their debt stack. And it'll tell you.
People don't do that. They don't go to an SEC filing. Like that's a lot of work.
So for me, it takes 2 seconds. I'm like, okay, how much debt is coming on? How much is due this year? How much is due next year and the year after that? what is the ability for this company to refinance? What is the current investment? Are they investment grade or are they drop below investment grade? Because that'll tell you what the current refinancing ability is. And then you go right in, then you could go into the other things and say, okay, if this company is a triple B, the current interest rate is this, which new issuance of debt is getting issued at this. So what is that going to impact on their earnings going forward? Once you figure that out, dude, the rest then it becomes super easy to invest in the equity portion, because now you know that there's value that other people are not taking the time to understand. And even these analysts, a lot of them don't do this stuff, you know?
Yeah.
So
this is good, dude. This was a great episode. This is a great.
It was the same thing with Disney. Remember, if you're on my Patreon, I went over Disney's entire capital stack. I said, look, this is their debt. This is what the debt that they incurred when they took on the Fox acquisition. So a lot of people are looking at Disney as a debt-ridden company, but then you also look at their cash flows and how much their cash flows are being used to pay down the debt. So as you pay down the debt, your equity goes up in value because your assets still stay the same, but your liabilities are slowly being, chopped away. And so this way, now you look at it from an equity portion. And
then it becomes asymmetric. Yeah. Then it becomes asymmetric.
Yeah. Exactly. And the thing is, like, the general market sometimes doesn't look at these things. And it's especially for businesses that have very predictable cash flows, bro, this is easy. And this is exactly why I think Buffett is probably buying Verizon. Just saying.
If he's buying PayPal, the world's going to erupt, but we'll see. All right, Chris, you got to go do your pod, right?
Yeah, I just got to check with Matt. Yep. I'll see you guys later.
All right. See ya. Vitaly, let me show you this one video. You got to watch this. It's 2 minutes. I went viral. I didn't know when you were sick, I went viral on Wall Street Bets with Adam. Someone posted it, got millions of views because me and him, this is how we reacted to PayPal's earnings. Okay. So this is what happened. That will get there eventually.
3% off. 3%.
Holy crap. Holy crap.
It's popping.
Holy crap.
4%. 5%.
Holy crap. Holy crap. Holy crap. 6%. 6%. Holy crap. Oh, it's 67. I'm trying to get the numbers.
7.5%.
Let's fucking go.
No, that green candle is gonna go pop up right now, bro. 8.5%. 8.5%.
What did they announce?
9%.
I'm trying to get this great. They had to announce something, dude.
9.3%.
9.5%.
10%.
10%. How long did this happiness last for?
Okay, so we got Andrew. They beat revenue by about 40 million.
Gonna get better.
Okay, so we got that number. Okay, here we go. They beat EPS by about 15 cents. I got it. They beat revenue by about 130 million. So there you go. You got to beat on the EPS and you got to beat on the revenue. You got to beat on the EPS. You got to beat on the revenue. And then the guidance numbers should be coming in very soon. And then the street will be able to react to that as well. Oh, we got to ring the bell for this, Adam.
Bro, it's going back down. Now it's even. People are not liking it. Now it's down. What the fuck? Down 5%?
How the fuck is this happening?
Bro, I have no idea.
You know the Joker? You know the Joker in The Dark Knight where he just starts laughing and then Batman keeps punching him and he keeps punching him and he just keeps laughing because all you can do is laugh? Dude, that was the funniest shit ever. We were so excited.
Dude, I like that name, Pain Pal.
If PayPal ends up being a value trap, dude, it's so many people on Twitter.
It's already a value trap. I don't know why you're saying if it ends up being, it's already a value trap, which we're all trapped inside of. Okay.
It's a trap.
I blame Jeremy. I blame Jeremy. Okay.
Yeah,
I did not give a shit about PayPal. And then I saw Jeremy's video. I was like, okay, yeah, let me take a look. Hey, they're generating cash flow. Hey, they're buying back shares. Yeah, this looks interesting. And that's what happens, bro. That happens. I'm just kidding, by the way. It's not Jeremy's fault. It's my own fault. Whoever buys things, that's on you, not on anyone else.
You don't have the pod, Chris? Not tonight?
No, I messaged Matt, but he didn't message. Oh, there we go. Yeah, all right.
Okay.
I'll see you guys.
All right. Everyone go check out Cash Flow Chronicles, Matt Money on YouTube. Check out his channel. This was fun. We'll be back next Monday. And yeah, are you doing anything over the weekend?
Can you post? Can you just post our Patreon and Discord as well? The Freelancer Finance. I think somebody asked. I don't have a link offhand, but if anybody wants to join our Discord, it's free to join. We also have trades. Some of them are better than Chris's. You would have followed us into Bitcoin and lost a lot of money on Enphase. There you go.
That's Vitaly's Twitter. That's his Patreon. I pay $10 a month to their Patreon as well, so it would help.
It's $5. It's $5.
Oh, $5. Oh, I pay 10 anyway. And then Discord as well. All right. Are you doing anything over the weekend or no?
No plans right now, but we'll figure out something. Actually, we had to go out to Cheesecake Factory, didn't we?
We got to figure it out. Yeah, we got to figure it out. We got to see you this Saturday. I'll text you. I mean, I'm going with my mom somewhere on Saturday, but Sunday I'll text you. We'll see.
Your mom could join us.
That was dirty, dude. That was a fucking piece of shit. All right. Thank you, everybody. Have a good night. We'll see you next week.
Right.
Bye. Bye, guys.